I've been with Housing and Credit Counseling for 13 years, so I think many of you know Anju. So of course she'll be back in our Lawrence office in a few weeks. Meanwhile, we do have some coverage there from a counselor from our Topeka office. So if anybody's needing one-on-one counseling or something like that, we can still help you. So don't hesitate to give us a call. I'm going to go over the first part of this class, and then I'm going to pass it over to Bob Mackey. Bob is our president and CEO of Housing and Credit Counseling, so you got the chief from our office tonight. So, all right. And I think has everyone been here before? Is there anyone who hasn't been to this class before? Yes, okay, great. So this is quickly a review of what Housing and Credit Counseling services are. So in a nutshell, we provide all of the things we're talking about in these classes, as well as tenant-landlord, where if you're a renter, we can teach people about their rights and responsibilities based on the Kansas Residential Landlord-Tenant Act. If you're a landlord or a renter, we can help you. And we also provide pre-purchase home buyer counseling and education as well. So if home buying happens to be one of your goals, that's something that we could try to help you with as well. Yes? Actually, I'm not connected. Can everyone hear me? I've got a mic, but it's to this camera. So as long as everybody in the back of the room can hear me, if not, I can project some more. Are you good back there? Yes? Yes? She is no. Okay. I'll try to be. Do you want me to be the microphone, or maybe I'll just talk louder? How about that? All right. Some of the trouble. All right, first of all, saving and investing. It's important to understand there are similarities and there are differences. So just a little bit about those. As we know, savings is the act of putting aside dollars for another day. We'll go into that a little bit more in just a minute. And investing is actually taking it a step further, doing something with that money. And Bob is going to talk more about that in the second part of the class. Can you hear me better now? Okay, great. All right, so just a little recap of what you have probably learned from the last several sessions. And again, this is class 5 of 8, so you guys have came a long ways if you've been to all these classes. So that's right, you can celebrate that you've done this. This is quite a commitment. And I know that in sessions 1 through 3, you had a little bit of repeat. Some of that is on purpose, so that it will stick with you better, and you'll be able to pick up certain parts of it in some nights and other parts in another night. So if you hear us repeat some things, that's on purpose. So believe it or not, non-monthly expenses were covered in sessions 1 through 3. Those are the items like car repairs, Christmas savings, let's see, what else might there be? Insurance, if you don't pay for your car insurance every month, it might be car tags or taxes. Those are the things that you would figure out what you're going to spend for the year and divide those by 12 months and save that money for that item throughout the year so you have it when you need it. So that's step 1. You got to have your non-monthly expenses. Step 2 is your emergency fund, and talked about that in session 4. Does everybody remember that? Great. It's covered pretty thoroughly. And generally, it's 3 to 6 months of your living expenses. Now, some people think, how am I going to get there? That just seems unreachable. But if you start small and eventually build to that amount. This is helpful for if, let's say, you lost your job or got sick. This can help you get by until you find another job, or your unemployment starts, or whatever it might be. Okay, and the next step, retirement, which Bob's going to talk about some of that in just a moment. College fund, that's something that's important to a lot of people. I know I started a 529 plan. I also have twins. Lynn was saying she has twins, so they cost a lot. And I'm not going to pay for their full college, but I'll give them a little start, you know. And other goals, which Bob will go into a little bit. Again, it's you decide what you do with your money. Okay? I'm talking more from this side, so if I go back and forth. All right, and for Social Security, I've just got a couple of slides on that, and we're not going to go into great detail, but I know that you in Lawrence have an office on Wakarusa. Does everybody know that? Great. And if you didn't, it's good to know that because you can walk in any day between, I believe it is 8 and 5 or 8 and 4:30. No, I'm sorry, 9 to 3:30 here in Lawrence, and you can get help. So please do take advantage of that if you've got questions related to Social Security. A couple of things to make sure. The annual statements used to come out about 2-3 months before your birthday every year if you're over the age of 25. But currently, due to budget cuts, they are not sending those unless you're at retirement age. So just know that. And types of Social Security, of course, there's retirement. Most of us are familiar with that. And disability, if you become disabled and apply for disability benefits, you can get that. But a lot of people don't think about survivor benefits. I've had clients come in for a credit counseling session who their spouse had passed away, and they were trying to raise a couple of kids on their own and didn't know about it. So sent them to apply for that, and that made a huge difference on their income. I don't know, some people might have heard of it as like widow's benefit. It's what it used to be called. So, and all of this information can be found online or just walking into the office on Wakarusa. And this is just in general. If your year of birth is one of these, then your retirement age could be that. Your full retirement income age. So kind of just a general idea if you know, of course, your own age, but you'll get an idea when you should be able to earn your Social Security retirement.
What if we're past the 60s?
Then it's still 67. Yep. Oh, retire now. That's a good one, though. Yes. And we were talking before class started, we were just a little bit, we were saying how even though you retire, you still have to save money. Isn't that crazy? You know, so Bob is going to go over how you might be able to go about that. So, okay. And next, the rule of 72. How many people have heard of rule of 72? Good. 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 And it's a little bit of a formula. So years to double your money, and this is something very important to know as you are thinking about investing or saving. You could calculate how long it will take you to double your money. This example, to double your money at 8% interest, if you're earning 8% interest on your investment, whatever that investment might be, then you divide that 8% into 72, the rule of 72, and that means in 9 years you will have doubled your money. So that kind of gives you an idea. Okay? And that's just like, it's like the time value of money, and it's compound interest. Often I talk about compound interest being charged to you in debt. Now you guys have already talked about debt in the last several sessions, but now you're going to talk about using compound interest to better you. Debt, you're, for example, a credit card, you're charged interest, and then the next month you're charged interest on that, plus the interest you've already been charged, compounded each month. Well, investing, it's to the positive. You get paid interest compounded on top of your interest each month. So use that to your advantage instead of them taking it from you. Okay. And just real quickly, I know you guys went over this in some past slides, but just remember, if invested at 5%, for example, a soda, $2, you could have $273,000 if you invested it. So for 60 years. All right. And to build $1 million, see the red up above, by the time of age of 65, this will give you a general idea if you want to find your age here, because we've got a variety of people in the room. This is great. And if you saved that much per day or per month or per year at your age, by the time you're 65, you would have $1 million. Wouldn't that be an incredible goal? Imagine. So again, we're going to all make our, next week is about goals. So think about that before next week, where you want to be. And I want to introduce this to you. I think we have internet access here in the library. I'm not going to take time to try to find it for you, but do know there are many calculators online. You don't have to use the old hand-type calculator or 10-key machine. You can just say FINRA, for example. FINRA, who has sponsored these classes, has many calculators on their website where you want to figure out how much money you want to save or at what age you could retire if you save this much, all kinds of calculators. So, empower yourself and look for those resources. And decide where you are today. Think about your age. Think about how much money you may need when you retire. Is your home going to be paid off? Are you just going to have a small amount of Social Security, or will Social Security be there when you retire? That's right. And where would you like to be? I mean, do you want that $1 million? Or are you going to be living a pretty simple life? Do you need very few things? That's good. Okay? And can I get there? Of course you can. You can get there if you try to take as many steps possible as you can to get to that point after you've set those goals. Okay? And how can I stay on track? So some of those things that Bob will be covering tonight and over the next couple of sessions, those will help keep you on track. Okay? All right. I have one more thing before I pass it over to Bob. We were talking before class started here about life expectancy, because as you think about saving for retirement or other investing, life expectancy, believe it or not, right now, is a man reaching age 65 today can expect to live until 83. That's a lot of years to be saving for your retirement. You've got a long time to pay for. We all want to live to be forever, but think about that. I mean, even a woman at 65 today will live until at least 85 on average. That's 20 years. How are you going to pay for that? So that's why these are important. Okay, thank you. I'll turn it over to Bob.
We are. One moment, please. Here we are. There we go. I am Bob Mackey, and how many can hear me out there? How many would rather not hear me? Okay. Fine. It's interesting that Marilyn brought me tonight to talk about the retirement portion of this meeting, as I'm in my 60s, and they don't refer to me as Bob at the office anymore, but the old guy. So I break the curve for average age there, so they brought me along to try to help you with the retirement situation, investments, and so on. So we'll see how that goes tonight. Thank you all for coming. This is a great crowd. I think it's been a great series, and we're just as pleased as we can be of being a part of this whole thing. Let's get started with systematic investing. This is the answer to life if you're an investor. I mean, how many times have you heard or read on TV that, oh, buy low and sell high and all that kind of stuff? Well, yeah. It's like Bill Self saying to his team before the game, score early and score often and we'll win, So that doesn't take a lot of thought to put that on there. But so how do we do that? And the first thing I want to talk about, and maybe you've heard about this too, is don't try to time the market, okay? Oh, it's up, it's down, it's I don't want to get in, I want to get out. That's the worst thing you can do. You need to stick with it. And so how do you do that? So how do you get it so you can buy shares when they're low and buy fewer shares when they're high, so you can basically have a cheaper amount of value in terms of the shares you purchase? We call it dollar cost averaging. And by that we mean you may put aside or invest, if you will, in your 401k if you have one, or some kind of investment, $100 a month, let's say. And you do it every month for 20 years or however you want to do it, or maybe you increase it over time. But what that does is it buys you shares when the price is low, and you can buy more shares with that $100 when the price is low. And then when the price is high, it'll buy you fewer shares. And so that's how you do it, by just putting money away and putting it in investment every month, if you're in equities, if you're in investment, or whatever you're in, so you can do that. A lot of people, if you've read or heard about, or maybe even had some friends, when the market was down to 9,000, what did they do? They got out, didn't they? A lot of them. They were afraid it was going to go lower. And what happened? The market today closed over 13,000. So for those people who got out at 9,000 and did not get back in, lost a great opportunity. So that's what I talk about timing the market. For the most part, history will tell you, you just stick with it, and over a long period of time, you'll be fine. Determining asset allocation. When we talk about allocation, particularly asset allocation, first we look at risk tolerance. And by that we mean how much risk are you willing to bear for return on your investment. And one rule of thumb that I have is that if you're in investments that keep you up at night, get out of them, okay? That's not a good thing. We don't want you to lose any sleep, and that tells you something about yourself and about how much risk you're willing to put up with in terms of getting a return. So that's the first thing you want to think about. You also want to think about income needs. And don't invest so much that you can't pay for that wedding that's coming up, or that trip to California, or to fix that car, or do whatever. So you have to look at that as well. Investing time horizon, sooner better than later. The one at the bottom there, what I may want to leave for my loved ones after I die. That's fine, and you can plan about that, and if you get back to what Marilyn said, if you want to get that $1 million, this is what you do, and if you want to leave it to your family, that's great. But the other way to think about it too is that if you live to be 85 or 90 and still have that money, and now your kids are 50 or 60, they may not need the money as badly. They'll still take it. I know my son will. You know, not that he's waiting for me to die, but he's ready. He's there and ready and waiting. But now is when my son needs it, because he's just starting out, just got married, and so don't forget about, if you have the resources, that you can gift up to $13,000 without paying any gift tax. Not that you need to do that much. I don't. But you don't necessarily have to wait until you die and then figure out how much you want to give them. So that's something to think about as well. Diversification asset allocation. And what we mean by that is spread out your risk, okay? So you may not want to have 100% in equities or the stock market if you're an investor. You may not want to have all of your money in a savings account that pays you, what, 0.6% or something. You want to be somewhere in the middle, depending on your age. Now, if you're younger, rule of thumb is you can have more money in the market if you're an investor, because you have a longer time for those ups and downs to even out and so on. But as you get older, like myself, they recommend that you start to walk away from the market a little bit, not totally, because like Marilyn said, we're living longer than ever before, so we could have 20 years there. So you still want to be in the market, but you want to diversify into bonds and cash and so on. So don't put your eggs in one basket, no matter what age you're in, but diversification is the answer in terms of having a good investment portfolio. They also have funds in the last 5 or 6 years or so, as you get a little bit older, and they're managed funds, and they call them different things, but you can pick your date of potential retirement, whether it's 2010, 2025, 2020, and what they do as you get older, they take more money out of the stock market for you and put more money in bonds and cash and so on. So those are plans you need to take a look at as well. Those are something fairly new and fairly well managed as well. The next slide there. Oh yeah, next slide. I'm used to having a clicker, so. Yep. See, at my age, I just forget things. So, how much do you need when you retire? Well, it kind of depends on you, what kind of lifestyle you live. It wasn't too long ago, maybe 20 years ago, 15 years ago, that they were talking 50 and 60% of what you earn now. And now they're talking 70 to 80%. As they find that the standard of living that we live in is different than what it was 25 years ago, and so on and so forth. So they're saying 70, 80%. I maintain that depends on a lot of things, and mostly it depends on how much money you owe when you retire. And the secret to a comfortable retirement if you saved properly is that you have your debt paid off. And the people that retire that still have a mortgage payment, a big mortgage payment, and they have another 15 years before it's paid off, still have a car payment, whatever, that adds to the equation and makes it more difficult for retirement. And that 70 and 80% becomes more realization. You're going to have that much money if you still have a big mortgage payment and car payment and some other payments, home equity loan, things like that. So again, it does depend on how much you owe. So make sure that when you have an idea of when you're going to retire, make sure you start planning or have a plan or a goal to pay off as much debt as possible, because it'll make your retirement so much more enjoyable, and your money will last longer. As that last one says, make it last, watch out for inflation. And when we talk about watch out for inflation, I'll talk a little bit later about how you can combat inflation with some Series I bonds, and we'll talk about how those work. Medical costs are another thing that you have to think about. You have to make sure that you don't retire so soon that you don't have medical insurance, either you or your spouse, and that can be a problem as well. And even your medical costs, even if you do have Medicare or a plan from your place of employment, it's still probably going to be higher medical costs than you experienced when you were 30 years old with medications and so on and so forth. So that's why the 70-80% makes more and more sense. Next one, please. Now we get into some tools and investment type programs. I'm going to ask a question here before I get started. Is there anybody here that works for the IRS? Okay, all right. So most of everything I say is pretty accurate, so I didn't want to go to IRS jail. So in any event, these are some employer plans. Of course, we have the typical pension and KPERS plan. And you've read a lot about KPERS and so on and so forth. Some of you maybe be a part of KPERS. I'm confident that they'll work that out, and maybe some of you aren't, I don't know, but hopefully they will, and I'm sure they will. We have a 401k and 403b. How many have heard of a 401k? Okay, how many have heard of 403b? Okay, what's the difference between the two? Anybody?
Profit versus nonprofit.
Yeah, very good. Thank you very much. But other than that, not much difference. In fact, some people think that you have more investment options with 403b. Oh, I'm sorry. The answer is 403bs are specifically for nonprofits, tax-exempt organizations, and one other interesting, actually individual. They are for ministers. Didn't know that till today. So, but other than that, the requirements, the qualifications, the way the payouts, the rules, and so on and so forth are the same. Now, any accountant will tell you, or any tax attorney will tell you, that the 401k, the 403b is the way to go, and you should take advantage of that first before any other investment. Let's say that your employer matches 50% for every dollar that you put in. Now, that's 50% return on your investment. You can't get that anyplace else. So accountants and tax attorneys will tell you, max that out. Take as much as you can, put as much as you into that 401k, and then after that, if you have money left over to save, then you can go to other instruments for savings. So make sure you do max that one out, because that's the best way to go. Next slide, please. What do I need to know? A lot of questions that hopefully your employer will tell you, or you need to ask. Do they match my contributions? We've talked about that. And if so, how much is the next one, so you'll know. And a lot of 401ks, 403bs are in increments over a period of years. The longer you're there, the more match you get. And also, the longer you're there, the more you are vested. And that means the more money, the money that you put in, and the employer puts in particularly, you get that back if you leave. So that's what, when can I get to it question?
There should be a limit on what they will manage, how high.
Yes, there is. And it wasn't too long ago, well, before the Great Recession, we just are in, not quite out of yet, there were a lot of employers that matched up to 100%. And then when the recession hit, you saw large companies start to back off to 50%. And then you saw those same companies no longer match for their employees at all. And that happened to a lot of companies, and some of them have come back and started to match again, and some of them haven't. So it's easy once you get out of it to get back in, but their employees, I think, will probably expect, because you'll lose employees if you don't start to get in competitive situation again with other companies that are matching their employees' contributions. So something to think about. You need to think about the tax ramifications that you may have with a certain investment. When can I get it? You need to understand about withdrawals and the penalties and all kinds of things. We'll talk about that in a minute. And if you quit your job, what kind of things do you have to be aware of? Your employer should do a pretty good job in letting you know when and how and so on and so forth you can get at that money, or whether you want to leave it in the company's program. You can do that too. Now, I think the limit is $5,000 or less. You can keep it in your capers, for example, for 5 years, and then you have to move it out. If it's greater than $5,000, you can keep it in over an extended period of time. So, but that's all a part of what you'll be learning if you ever do leave your place of employment. Now here we get into some instruments of savings. And first of all, we have the traditional IRA. And that's been around a long time. And you can have an IRA to do a couple of things for you. First of all, you can set aside, if you're if you're younger than 50 years old, you can put away up to $5,000 a year. And you may be able to get a tax deduction as well. And I say may. Please check with the IRS, because there are different circumstances that say yes you can or no you can't. If you're over 50, you can put $5,000 plus another $1,000 or $6,000. It's called the catch-up rule, so you can do that as well. Your contributions and earnings will not be taxed during the whole time those funds are in that IRA. And then if you choose to, after age 59 and a half, start to take withdrawals, then that's when the earnings start to be taxed. Now, if you take the money out because you have to have the money, as many people have done, and you may have read about people taking money out of their IRAs and 401ks and so on prior to 59 and a half because they have to pay their mortgage, they have to pay their kids' college tuition and so on and so forth. We see a lot of that in housing credit counseling when they come in. Now, if you do that, you have to pay a 10% penalty if you make a withdrawal before age 59 and a half. So be careful about that, be aware of that before you make that decision. Unfortunately, some people didn't have a choice and they had to go to those kinds of investments to get the money they needed to continue to live, make mortgage payments, and so on and so forth. Now, what's the difference between a traditional IRA and a Roth IRA? And I'm doing this without a net here, but Roth can be kind of complicated. First and foremost, and by the way, the traditional IRA, another age qualification there, at age 70 and a half, you have to what? You have to start taking withdrawals, don't you? Because it's a retirement program. It was set up that way by the government, and they want you to start taking withdrawals. One of the advantages of the Roth IRA is, one, you don't have to do that. Okay? You don't have to take withdrawals out at all if you don't want to. And two, you can continue to contribute to the IRA after you're 70 and a half, which you cannot do with the traditional IRA. So now, the caveat, you're saying, how's that, what's the catch? And the caveat is that the Roth IRA, there's a limit on the income levels of people who can contribute into a Roth IRA. 2012, a single person who earns $125,000 up to $125,000 can still contribute to a Roth IRA. If you file your taxes jointly, you can make up to $185,000. There is no income limit on the traditional IRA. Okay, so there's the differences there as well. The Roth IRA, one, you can withdraw your contributions, not your earnings, but your contributions at any time before 59 and a half or whenever and not pay a penalty. And also, you can again, the 70.5 rule of not having to take any money out at all. The other advantage is that for different situations, you may not pay taxes on your earnings at all for either state or local. But again, talk to the IRS. If you have a tax accountant, talk to them too. But that's one of the advantages that is the difference between Roths.
Wasn't the main thing about, one of the main things about a Roth is you kind of like are paying taxes on it now so that you don't pay taxes on it when you withdraw it later?
To a certain extent, yeah, that's correct. But in the end, most accountants will tell you that the Roth IRA is still the way to go in terms of overall taxes at the end of the day.
Oh, yeah.
Mhm.
Plus you can,
Not that I'm aware of.
plus you can buy real estate in a Roth IRA.
Sorry?
You can buy real estate too in a self-directed Roth IRA
Yes, you can.
and not be penalized.
Mhm. That's true. Now, we go to annuities, and very quickly here, annuities are basically a guarantee for return on your investment. It's basically an income flow, and there's 3 different ways you can do it. You can work with an insurance company, give them either a lump sum amount or a monthly amount, agree to the amount that you would like to receive at retirement. They may invest it in 5% or 6% investment so you can get the money out of it you want. That's called a fixed IRA. You have an indexed annuity where it is based on one of the indexes, either the S&P or something like that, and you will get some kind of an agreement on how much money, even if the market goes up or goes down, there'll be some kind of an agreement as to how much money you'll be getting at retirement. There are some now that will guarantee you that if you invest last year in March and what you put in is now less because the market's down, they will guarantee you at least a 5% return on the investment that you made. So there are lots of different programs out there now. So when you get to that point, or if you're interested in annuities, really shop around, and because there are all kinds of ways to do that. Now, CD, certificate of deposit. Obviously, we all know what that is. They're paying, as you know, high rates of interest right now, so everybody's got them. Yeah. How long do you have to go out to get a 1%? You know, like 2 years or something, you know? Now, I'm old enough to know, and some of you are too, that back in the early 70s or so, we were getting, what, 12, 14% on our CDs, paying 10% on our mortgages, though. But those were the good old days. Money markets were paying 9 and 10%. Now, those were the glory days if you were a saver. And for some of you who are young, yeah, that really happened. So, yeah, it's kind of hard to believe, but it really did. So, CDs are good for lots of reasons, though. It's a good alternative and a separate. We got talking about asset allocation, and having CDs in your portfolio is a good idea for lots of reasons. One is ready cash. You don't have to call a broker and wait 2 weeks maybe to get the money. Although my broker's pretty good and he can get it to me fairly quickly. And they're doing better on the job of that because they know they have to. But it's good to have that money ready at either it's a one month CD, a 3 month CD, or if it's a money market, it's there for you. But what's the one difference between the CD and these other 3 investment tools? What's the one difference?
Insured.
It's insured. That's right. And you know, that's not all bad. And so right now, with the economy being unstable as it is, it's nice to have some money that is insured. And we'll talk about bonds as well here in a little bit, but it's nice to have those CDs, and there's nothing wrong with it. You may have some friends that talk about, I play in this tennis club Tuesday nights. You know, I'm supposed to be playing tonight. I would be on the court right now losing. But in any event, a lot of talk between matches about their investments, you know, and how much money they're making and all this kind of stuff. But at the end of the day, it's good to have a CD or something around to kind of manage that out. And of course, I don't believe half of what they say anyhow about how much money they're making. So, in any event, that's something important to have. So, On to the next one. We talked about this a little bit before, about when can I get to it, what about taxes and so on. So any investment that you have, those are good questions to ask, because there'll be a point in time in your life where you may need to get to it. And you need to understand the tax ramifications before you get into an investment. And when can I start it? And if I quit my job again, what are the ramifications of the investments that I may be having, or maybe may have at the workplace? So again, we talked about that one. Options to reach retirement. Again, I'm supposedly the expert at our place because I'm so damn old, but options to reach retirement. Save more money. Yeah, okay, that's like, you know, buy low, sell high. Save more money. Now, how do you do that? Well, first of all, you need to decrease your expenses. You're not going to be able to save more money. And Marilyn, being a certified credit counselor, I'm not. I'm a retired banker of 30 years. But we work with people on budgets. And for those of you who were at our first meetings or two, you heard about a budget, how to work it, and how to reduce your expenses. And basically, the end of the day, the goal is to also start a savings account. One, for emergency reasons, as Marilyn pointed out, 3 to 6 months for emergencies, and then get into a situation where you might want to save for retirement and or education for yourself or your children. And so those are all the kinds of things that you need to do to think about retirement. But for God's sakes, pay yourself first. You've heard that how many times before? You know what? It really works. So when you write checks out or pay online or do whatever, pay yourself first, whether it's $10 a week or $50 a month. You saw the charts. And if you're 20 and 30 years old, I think the 20-year-old was like only just $6,000 a year. And I say only. But for those of you who are disciplined and don't have a lot of bills, that's not that far off. It's not that hard to reach. So you could be a millionaire if you start now. What do we got next here? Stocks, bonds, mutual funds? Okay. Anybody in the IRS? Okay, I'll ask a question. Okay. I have to be careful about this. So stocks, as you know, are stocks. And whether you buy General Motors or as Forrest Gump did and his Lieutenant Dan, they bought Apple, if you remember. And Forrest thought it was a fruit company. And so it turned out not to be the case. And of course, he got stinking rich and so on and so forth. So, but stocks take a lot of time. You have to really, if you really want to invest in individual stocks, you really have to study them, and you have to get on programs and watch the news and read the Wall Street Journal and have all kinds of fancy charts on your PC and so on to make sure you're making and follow a stock for some time. And then the stock is in a certain industry. Then you got to follow the industry. So a lot of work. Sometimes it pays off. The guys at Tennis Club tell me that, so I don't know. They're making millions of dollars, by the way, all the time, every week. So bonds, they can be corporate bonds at different rated levels, and you can be AAA, they can be BBB, they can be A-, and the higher the rating, the better off it is in terms of safety of the bond and oftentimes the return as well. But there are also government bonds, municipal bonds, so on and so forth, and we'll talk about that in a minute. Mutual funds, that's a part of, if anybody has a 401k or a 403b, those are some of the funds that you can invest in, so you don't have to do so much work. So you invest in Oppenheimer Main Street, and you can find out what kind of stocks are in there and what the weight of those stocks are, what industries those stocks represent. And so you get a feel, and you have the power of many because there are so many people invested in that fund that now you become a big investor with everybody else instead of working so hard to find those individual stocks. So mutual funds are very popular, and an investment tool that's with every 401k, even an IRA program, and 403b and so on and so forth. Exchange traded funds, a little bit different from mutual funds. How many have heard of those? They're not all that well known, but they've been around since 1993. The difference in this as opposed to mutual funds is that the ETFs, as we call them, oftentimes focus on indexes. In other words, they may have a fund that just follows the S&P index rather than mutual funds that you can say, I want to be in this fund because they invest more in banks than they do in other places. The other thing that's different about it is that mutual funds, I'm kind of getting into a place here where your eyes are going to glaze over, so I hope I don't lose you, but mutual funds, when they deal during the course of the day, you never know the value of that fund until the stock market closes and what they call a net asset value. And then you know the worth of your mutual fund at the end of the day. The ETFs are like stocks. They have different values during the course of the day. So you may have the opportunity to sell because you know the value is up or down, and you can short or long. I won't get into that. But so you can almost treat them like a stock. They become very popular to the point where they're one of the most popular traded funds in the country right now. So something to look at, but you need to understand them before you get into them or have somebody explain them to you at great length. Real estate investment trusts are what we call REITs, and they came in back into the early 90s as well. And how many remember the REITs when they first came in and there was a thing to do, and then what? The bottom fell out, didn't it? And in the late 1990s, early 2000s, when we had some real estate problems, all of a sudden they became junk bonds almost. I know when I was in banking, I sat on different boards of directors, and I remember board after board, they have an investment plan. And one of the things that they quickly did is they took REITs off the list of investments that they could do because they had such a bad reputation. Now, guess what? In the last couple of years, they're like ties. You know, don't throw a tie away because it may come back in style. Well, guess what? REITs are back in style now and not doing too badly. Now, there are two types of, well, basically two types of REITs. One, an equity REIT, and that is for basically commercial or rental properties and so on. It could be shopping malls, it could be hotels, could be resorts, could be anything. It could be a series of multifamily housing groups. And then the earnings that you get are the rents paid from those rentors, okay? And that's where the bottom fell out of the commercial market that made REITs a bad name, because the commercial market really started to get bad in the late 1990s rather, and the early 2000s. The other one is a mortgage REIT, which is a little better. The mortgage REIT, again, is a pool of funds that you are paid from the interest on the payments of those mortgages. So it's a little more sound, but in today's housing world, you know, it kind of depends on what pool you're in and whether they're actually making their payments. Yes, sir?
What's the difference between what you just described, the mortgage REIT, and the mortgage-backed securities that we hear about in the news all the time? I think that's what basically the same thing that was going on, right?
Not a lot, with the exception of how they pay. And the only way that the REIT mortgage pays is through the interest rates and the payments from those interest rates from the mortgages. When you get into mortgage-backed securities, there are different ways to receive funding. And a lot of times mortgage-backed securities are broken down into separate groups. And you may have a group that is interest only. You may have a group that's a certain kind of mortgage. They call them triage and tranches and so on and so forth. And they're much more sophisticated than the REITs, at least in my mind.
But on this, if the bottom drops out and people foreclose and stuff, you lose your money, you don't get anything from it.
Yep, that's right. Yeah, you're exactly right. Point being, did everyone hear that? Mortgage, the mortgage part is maybe a little better than the equities, but guess what? If people stop paying, same thing can happen to the REITs. And just throw out a figure, 1 in 10 homeowners in Topeka are currently behind on their loans. 1 in 10.
So that's not necessarily a good investment.
That's not necessarily a good thing. I'm not suggesting that you do a REIT. I'm not suggesting that you don't. I'd be really careful, okay? So the housing market, someone told me the other day, or I read somewhere, there's another $6 billion in mortgage loans that are in the pipeline for being foreclosed this year, or in the next couple of years. So we are way far away from having the housing market come to some kind of normalcy, as they talk about. So,
Did you say 6 million or billion?
billion,
Okay.
yeah, you heard me. Yeah, so they're still coming. Okay, where are we at? 521 plans. We got about 2 minutes. So 529 plans are great for savings. They're much like IRAs, tax deferred. They're more flexible because you make withdrawals for education at an earlier age. You don't have to worry about 59 and a half. The Coverdell Education Savings Account is similar to that, but not as good. I won't go through that. Custodial accounts are just that. They are accounts set up oftentimes for education where the parent or guardian, which is typically a parent, is the custodial or custodian rather for the individual in the case that maybe their son or daughter or maybe someone else. And the only way that that individual son or daughter or beneficiary, as they call it, can get money out of that account is if the custodian says it's okay. Series bonds, savings bonds, Series EE and I. We just have a minute, so I'm going to spend more time on the Series I bond. That's for protection against inflation. And as we come out of this recession, hopefully, we'll probably start to see some inflation. And a lot of people are looking at or have owned I bonds for some time. And they go up or down, but you never lose any money on your principal because it's guaranteed by the federal government, okay? But what you can do is that you can make money on it when inflation starts to rise. And there's a formula, and I won't go through it, but I can tell you right now, I looked at the rates today, and when they price them every 6 months from November 2011 through April 2012, there's a composition of fixed and inflationary calculations. And right now, an I bond is paying 3.06%. Okay?
Is that considered a war bond or what they refer to
No,
as a war bond?
no. It's something they came up several years ago to when inflation was high, and to try to combat, if you will, because if you have a savings account and it's only paying, or let's say back in the day, 5% and inflation is 4%, you're netting out 1%. So that's the reason why they developed these bonds, and I would take a strong, hard look at those. I'm not recommending anything, but in terms of asset allocation, we talked about that, spreading it out, not having all your eggs in one basket. Having a few bonds is not a bad idea, and even bond funds. But this is one to take a look at. It's kind of interesting to look at, and I can talk more about it if we had time. Yes, ma'am?
Do you have to keep it a certain time?
Yes, you have to keep it, good question. Do you have to keep it a certain time? You have to keep it at least for 1 year. You can't, the government looks at it as a long-term investment, and that's why they can pay you a little bit more for it. So you have to keep at least 1 year before you even try to cash it in. And the Roth IRAs, by the way, you have to be in a Roth IRA for 5 years before you start getting some of the advantages of that, by the way. Go ahead.
On a custodial account, is this, since this is more directed towards college funds,
Yeah.
would would that require that you prove that the expenses are related to school, or, okay? So
Yeah.
it couldn't be just, well, hey,
Yeah.
Mr. Custodian, I'd like it
Yeah,
to be.
in fact, the custodian or the bank or whomever would write out a check made payable to bookstore or tuition or so on and so forth to make sure that you can claim it properly on when you file your taxes. Yes, ma'am?
When my children were little, my grandmother purchased some sort of bonds for them every birthday and every Christmas.
Savings bonds, Series E, double E?
I'm thinking double E.
Yeah, probably so.
Okay, so these bonds don't have a maturity date till like 2020 or 2030?
Yeah, sometimes 30 years.
Okay,
Yeah,
so, of course, that's not helping now during college years.
yeah.
So what at that time, what do they do with these bonds? Do you take them to a bank? Do you, what do you
Who's,
do? with
who's
them?
they, the owner of the bonds?
They're in my children's names. They're in mine and my children's names.
Yeah,
both.
put them in a safe deposit box.
Okay,
With
Yeah.
the cash.
Well,
She's asking where the cash.
that's where they are now.
I'm sorry?
That's where they are now, but what do you do with them at 2020 or 2030? Then you take
Okay.
them to a bank?
You can take them to a bank, they might be able to help you. You can also get online to the US Treasury and they can tell you how to do it as well,
Okay.
okay? And by the way, you can't buy them at banks anymore,
Yeah.
like you used to in the old days. Remember when everybody'd buy them and give them as presents and so on and so forth? You have to go straight to the website of the US Treasury to buy them. And they're dollar for dollar. It used to be you want a $50 bond, you give them 25. Now if you want a $50 bond, you give them $50. If you want a $10,000 bond, which is the limit for a Series EE, then you give them $10,000. Yes, ma'am?
I'm a state employee and we have a deferred compensation option. Can you just briefly talk about how that operates over the long term compared to, say, a traditional IRA? I mean, my understanding is I'm using pre-tax money and then I get it later. So how is that really different from a traditional IRA?
Not a lot. Yeah, no, you wrapped it up right there. It's deferring income. It's a separate program. I won't get into the great details, but it's not so much different. You probably have more flexibility as you do with an IRA, but not all companies, not all places offer them, and that's the difference. They're not they're not real common. So good for you.
The 401k at my company has us in a mutual fund,
Uh-huh.
and they do it based on like a date where they believe you're going to retire.
Yeah. Uh-huh.
So are those worth it to just let them ride? Because it's
Is
a
that the
mix
only
of
option
stuff?
you have?
No, I can actually go in there and like mess around. and
Mutual
change.
funds and stuff?
Yeah.
Yeah.
Is it worth it to just let it ride till supposed retirement age, or is it better to go
Can.
and check how things
You
are
can.
going?
You're probably a little young, maybe, to get into that, but it's not a bad thing to get into that at your age. What it does do is it does manage it for you. So you don't have to worry about how much you should have in bonds, how much you should have in cash, how much you should have in mutual funds and equities, and so on and so forth. So really, at any age is fine. It was originally established for people who were close to retirement in their 50s, let's say, and they just didn't want to have to worry about it anymore. But you make a good point. It's not a bad thing just to let it ride and let them take care of it. Yes, ma'am.
Are the I-bonds a good retirement tool? You listed them under college savings. Would you recommend them for retirement?
Well, I'm not going to recommend anything tonight because I don't want to go to jail. But I think they're good. I think they could be a good investment. I always say that. I think they could be a good investment hypothetically at any time. Yeah. I have some. Question? Yes, ma'am.
Yeah, on page 5, under how much do I need?
Uh-huh.
There's this one line that says 10 times current earnings.
Yeah.
We didn't touch on that. What is that referring to?
I don't know. Do you know? I saw that.
And that is actually information that came from FINRA.
Yeah.
The FINRA educational materials, that obviously they think whoever put that material together said 10 times what you're earning now. Of course, it's going to depend
Well,
on your age.
See,
Well, they tend to.
I didn't take it that way because 10 times earnings has a lot to do with price per stock ratio. And I don't know if they're talking about that either. But the 70 to 80% is what you need to focus on. 10 times earnings has nothing to do with the 70, 80%, so I just kind of ruled that out. They may know, but it's in all my years of banking, I'm not sure that fits. Yes, ma'am.
You talked about keeping a Roth IRA for 5 years before getting the advantage of it. What did you mean by that?
I'll have to check my notes, and my notes are way over there. But before you can make sure that I think it's the earnings aren't taxable, you have to keep it 5 years. Yes, ma'am.
So other than a class like this, HCCI does not offer
Inve-
investment counseling?
No. No, we don't.
Do you have any suggestions for someone who knows only what I've heard in the last 45 minutes about investing to go to get some good advice without paying out the wazoo and making someone else rich instead of helping myself, where do you go and?
Some of
probably
our
already
future
in
classes
jail.
will cover that. The future of the next couple of classes, some classes will cover that. How to shop for a financial planner or advisor.
On the 13th, is that right? On the 13th, we're going to have some attorneys here from the Kansas Securities Commission to talk about that very thing. But since you asked the question of me, it's not unlike other things that you might shop for, whether it's a new car or a new home. You may talk to your friends and say, you know, I'm looking for a broker. Who do you use? And they say, I've got this person who is reputable. He's been in the business forever and ever, and I trust him with my life, you know, on and on and on. You might talk to your bank or a financial institution, if it's a credit union or something like that. They may have some ideas for you, or they may have a trust department as well. And if you trust your bank or credit union, particularly credit unions don't have trust departments, but if you trust your bank and have been there a long time, you might trust the trust department, so to speak. So I would start there as well. Okay? We've got how many minutes? 2. How did you know?
You mentioned taxes, planning ahead for taxes, especially if you have tax deferred. And I was told a lot as retirement age approached, et cetera, that your taxes will go down when you are retired.
They won't go down?
No, not usually. I mean, the taxes go up. All the time they go up, and you don't really plan for that. But it's just a.
Well, yeah, the school of thought is, good point. The school of thought about taxes were not going down as much as you thought when you retired. The school of thought was that you're not making as much money, therefore not as much taxes, okay? So, but depending on where you live, there are other taxes too. Property taxes, state income taxes, of course that's trying to be changed and so on and so forth. And so it depends what situation you're in. There's a lot of retired people that are drawing Social Security, still working, and you know they're paying a fair amount of taxes. So you have to balance that, you know, that issue too of how much money can you make if you still want to work, but yet you're drawing Social Security. So that's something that you really have to work with, either the Social Security Administration or an accountant or tax attorney. Yes, ma'am.
If you don't have a whole lot of extra and you've got your budget going, you've got your savings for your 3 to 6 months, would you keep, I guess my question is savings versus investing.
Yeah.
Would you keep just that 3 to 6 months in savings and everything else that you can spare you invest?
Yeah.
Or do you do any more in savings?
Yeah.
How do you balance?
When I was a junior at Ohio State University, I had a finance professor tell me that, or tell the class that, and this is 45 years ago, or 40 years ago, if you don't have money to lose, don't invest in the stock market. But he was very conservative. But I think you're right. I think what he was trying to say, keep that 3 to 6 months always, because that's money you can't lose, in my mind, or don't want to lose. Now, then if you have extra money coming in that you can put aside, and you're building it up, and you're building it up, and you're feeling pretty good about where you're at, then that's a time where you might want to start taking a look at investments, and particularly those that will help you, you know, tax-wise in the future, long-range retirement, the programs that are 2012 retirement, 2025, or in your case, 2060. You know, just a whole host of things. But you're right. The first 3 to 6 months are sacred. Keep that aside, and that's what he was saying. Don't lose that money. Only when you have money to lose. I know. I think we're out of time, so thank you so much for your attendance. Great questions. Appreciate it.